Hello and welcome to another tutorial video. This one is going to be all about levered free cash flow and the levered DCF, or as I call them, how to go down a rabbit hole without actually finding any rabbits. Now, the most common questions we get on this topic go something like this. Should I use a levered DCF, a levered discounted cash flow analysis, or an unlevered DCF to value a company? Which one is better? Do they produce equivalent results? And then how do I set up the assumptions in a levered DCF? Now, I'm going to answer all these questions and give you a very short version of these and then go into more extended demonstrations. But first, I want to state my own biased opinion here, which is that it's a waste of time to think about or use levered free cash flow or a levered DCF in 99% of real-world scenarios. You need to know the basics for interviews, but at banks and other finance firms and in your own investing, it's quite rare to use any of this. So this is much more of a theoretical question and exercise than a practical one. If you want to get all the files, resources, screenshots, and a text version of this tutorial, you can go to the URL on screen. This is very long, so I will paste this below the video. I'll link to it there. So just look at the first pinned comment or look at the description and you can navigate to this URL. It's just levered free cash flow and it's featured on our knowledge base on the Breaking Into Wall Street site. So here is the lesson plan and outline for this lesson. It is going to be a little bit longer, so I will paste in the timestamps here as well so that you can skip around more easily. First, I'm going to give you a basic definition of levered free cash flow and an Excel demonstration. Then I will describe the changes that are required in a levered DCF analysis. Then I'll go into some issues for US GAAP versus IFRS and how these accounting systems also create some differences in the levered free cash flow metric. Then I'll explain why levered and unlevered DCF analyses are not equivalent and do not actually produce equivalent results in real life for real companies. And then I'll wrap up by addressing whether or not levered free cash flow is ever useful or whether it could ever have potential use cases for certain types of companies. Let's go to part one and give you the basic definition here first. The idea here is that levered free cash flow, also known as free cash flow to equity or FCFE, represents cash flow to equity investors, the common shareholders in the company, rather than all investors in the company. If you want to give a simple formula for it, it would look something like this. Net income to common plus depreciation and amortization plus or minus deferred taxes plus or minus the change in working capital minus capital expenditures plus or minus net debt borrowings. Let's go into Excel and take a quick look at what this looks like. So you can see a standard unlevered analysis up here where we go to operating income, we subtract taxes to get to NOPAT, we add back many of these non-cash charges or adjust for them. We have depreciation and amortization, deferred income taxes, the change in working capital, capital expenditures, and we take all those together to get to the unlevered free cash flow number. By contrast, with levered free cash flow, if you look at what we're doing, we're not just stopping at operating income. We're subtracting that net interest expense to get to pre-tax income. Then we're subtracting the taxes. Then we get to the net income or net income to common at the bottom. If we have preferred dividends, we have to subtract those to get to the net income to common. Then we add back depreciation. We factor in deferred taxes, the change in working capital, CapEx. All that's the same, but the differences are that we also now have to include the new debt issuances and the debt principal repayments for this company. So in short, we have these two major differences, subtracting the net interest expense and then factoring in new debt issuances and debt principal repayments. And these differences, though they may seem small, end up completely changing the numbers here. And that is levered free cash flow in a nutshell. So as I just said, the main differences are that we deduct the net interest expense and preferred dividends if they exist. And then we also have to factor in other income and expense and then debt issuances and repayments. Now, you might be thinking right now, wait a minute, isn't this what we want? Because normally in a valuation, when we value a company, we want to figure out how much its shares are worth. So if the company's share price is $100, how much should it be worth? Should it be worth $150? Should it be worth $75, $25, $50? Isn't it better to use a methodology like the levered DCF that produces the implied value of the company's shares directly? And you'd think this is very logical, but actually setting up a levered DCF analysis requires substantial extra work. It requires a lot of extra changes throughout the analysis. And in some cases, you need to make a lot of educated guesses on the additional assumptions. And in a lot of cases, I would argue that it borders on guesswork rather than an educated analysis. even if you get all this right, a DCF that's based on levered free cash flow tends to produce less consistent results than a standard unlevered DCF, and that's why we recommend against using it in almost all cases. Let's go to part 2 and talk about the changes in a levered DCF in more detail, and in each case, I will show you the difference between an unlevered analysis and a levered analysis in our sample Excel file. The first change is that the discount rate needs to be the cost of equity rather than WACC. So if you go to our Excel file here, in this unlevered analysis, if you look at the present value of unlevered free cash flow, we are using WACC for the discount rate. So WACC up here is calculated as you always calculate it. We factor in the cost of debt times the percentage of debt times 1 minus the tax rate. Then we add the cost of equity times the equity percentage right here. The company has no preferred stock, but if it did, we'd factor that in as well. Whereas in the levered free cash flow analysis, if you look at the present value numbers here, we are just basing this on the cost of equity. So we go up and we just use the cost of equity for the discount rate. And then for all the other calculations that rely on this, like the present value of terminal value and the present value of the free cash flows, for example, we're also using the cost of equity for the discount rate. The next change is that we need to subtract the net interest expense. And if the company has preferred stock, preferred dividends, and if the company has other income or expense from non-core sources, we also have to factor those in. And then we also have to add the debt issuances and subtract the debt principal repayments. So once again, going back to Excel, you can see most of these changes here with the levered free cash flow analysis. We have the new debt issuances and debt principal repayments. And then if you go further up, we're also deducting the net interest expense here. We're essentially assuming that the company has almost no interest income here. So I'm just basing this on the debt balance and the cost of debt, or the average interest rate on the debt the company has, but that's the basic idea. With terminal value, we have to use a PE multiple or another equity value-based multiple rather than the standard EBITDA multiples or EBIT multiples that you might use in an unlevered analysis. So if you go up and look at our unlevered DCF here, we're using a pretty standard approach, basing the terminal value on a terminal EBITDA multiple and the final EBITDA in the projection period. In the unlevered analysis, though, we are using a PE multiple instead, and we're basing this on the company's net income in the final period right here. We're multiplying by the relevant PE multiple to calculate the terminal value. If you want to use the perpetuity growth rate method, we are simply applying a long-term growth rate to the levered free cash flow in the final year to get to our terminal value right there. Another difference is that in the ending calculation, the DCF here produces the implied equity value directly. So we don't need to back into it using the enterprise value bridge. Let's take a look at this. In an unlevered analysis, we get to the implied enterprise value, but to figure out what the company's shares are worth, we have to add cash and other non-core assets, and then we have to subtract debt and finance leases and preferred stock and possibly operating leases and non-controlling interests and unfunded pensions and so on. So all these financing sources, that gets us to the implied equity value. Then we divide by the shares to get to the implied share price. Now, in a levered analysis, we don't do any of that because at the end, we just get the implied equity value right here and we divide by the share count to get to the implied share price. So we don't have that bridge at all because we get to the implied equity value directly at the end of the analysis. And then one final difference here, or one final thing to be aware of, one thing to check, is that anything that is in the bridge in an unlevered DCF has to be in the levered free cash flow projections and calculations directly in a levered DCF. So for example, if you have cash in your bridge in an unlevered DCF, you have to add the interest income from that cash in a levered DCF. If you have debt in the bridge, then you have to subtract the interest expense from the debt and then add issuances and subtract principal repayments. And you can see that we are doing that here. We are adding the issuances, subtracting the repayments, and we're subtracting the interest expense. We're assuming that the company earns no interest income here, so the interest income on cash is effectively zero. But since we no longer have this bridge, we need to reflect the effects of all these items directly within levered free cash flow instead. Now, if you have more than this, a much more complicated capital structure, the list goes on. So if the company has net operating losses, you have to reflect the tax savings from them in the free cash flow projections. If they have preferred stock, you have to deduct the preferred dividends. If the company has unfunded pensions, then you have to make sure that the entire pension expense is deducted in the levered free cash flow numbers. So not just the operational component, but also the financing components, assuming they have an unfunded pension. And then one final point I want to mention here is that with levered free cash flow, there's no way to treat convertible bonds properly. So in other words, you can't do a check to see whether they should be counted as equity or debt. You have to just pick one or the other and go with it because there's no bridge at the end. So normally, if you have an unlevered analysis, you would put the convertible bonds as an item here, and depending on the results of your analysis and the company's implied share price, they would be counted as either debt or equity, but you can't do that in a levered analysis. You have to pick one and go with it, and there's no room to adjust your assumptions based on the output of your analysis. Let's go to the third major topic here and talk about US GAAP versus IFRS differences in levered free cash flow. The main difference here is related to lease accounting and how everything has gotten very confusing after 2019 when these rules changed. The main point is that you need to subtract the entire lease expense for both operating and finance leases, regardless of whether it appears as rent under US GAAP for operating leases or whether it appears as depreciation and interest, which applies to finance leases under both systems and applies to operating leases under IFRS. That's because there is no bridge here. So we don't have an option to count leases either within the bridge or in the cash flow projections directly. With unlevered free cash flow, theoretically, we could just ignore or add back the operating lease expense and count operating leases within the bridge because we have that bridge. But with levered free cash flow, that is simply not an option. And so, for example, for a company like Vivendi, you can see that when we calculate levered free cash flow under IFRS for this French company, we add back D&A excluding the lease D&A, and then we have all the normal line items, repayment of debt principal, new debt issuances. We start with net income to common here, and the reason we do this is because the net income figure here for the company has already deducted the lease depreciation and the lease interest. And so we are being very careful not to add those back in the depreciation and amortization figure. And specifically, we went into the filings and made sure to count only the non-lease portions of the company's depreciation and amortization. So you have to subtract all components of the lease expenses here, and you don't want to add back anything in the calculation. If the company doesn't disclose this information, you could also just add back the entire depreciation line and then subtract the lease principal repayments, which should be in cash flow from financing. But I think it is a little bit easier to do it this way and to just subtract everything to get to net income to common, and then do not add back lease depreciation when you are calculating levered free cash flow. Let's go to the fourth topic here and talk about why the unlevered DCF does not produce equivalent output to the levered DCF. And if you've been paying attention to the Excel file so far, you probably see it. Our levered analysis gives us a company that is undervalued by about 10 to 15%, but our unlevered analysis tells us that the company's overvalued by anywhere from 0 to 5%, something in the low single-digit percentages. So these numbers are not dramatically far off, but I also would not say that these are at all equivalent. Let's talk about why that is. Normally, when we present this topic, the questions go like this. People understand that the levered discounted cash flow analysis has a lot of disadvantages and takes more work, but shouldn't it produce results that are similar to those of an unlevered DCF? And the answer is no. You're often going to see differences of 10 to 20%, possibly even more than that. It's not that much, but I would say that it can make a difference in stock picks and stock pitches and client recommendations. The reason why this happens is that it's very difficult to reflect all the items formerly in the enterprise value bridge in an equivalent way in the levered free cash flow projections. Let me give you a specific example of what I mean. Let's say that the interest rate on debt the company has rises from 5% to 10%. That's going to affect every single levered free cash flow, maybe quite substantially depending on the company's debt balance. But it's only going to make a small impact on the market value of debt in the bridge in an unlevered DCF. Let me illustrate what I am talking about here. So let's say that the company right now has a pre-tax cost of debt of 5%. If I now change this to 10%, so in the bridge for the unlevered DCF, the market value of debt will change by a good amount if the interest rates go from 5% to 10%. And specifically, this debt is now going to be worth less in terms of market value simply because investors can now purchase new debt on the market and get a 10% yield rather than a 5% yield. So this will go down. Maybe it'll go down to 2,200. We're not sure exactly, but it will decrease by some amount like that. Now, in the levered DCF analysis, you can see the problem here, which is that, yes, our interest expense is now much higher. Our pre-tax income is lower. Our levered free cash flow numbers have all changed, but we don't get equivalent results here. With the levered free cash flow, now the company actually looks even more undervalued, even though counterintuitively, they're now paying a higher interest expense. So you get these weird scenarios like this, where the changes that you make in one part of the analysis are not exactly equivalent to the ones in another. So that's the first problem here. The free cash flow in a levered DCF is also a lot more volatile, and you can see some examples of that down here. Because of the fact that we have huge debt repayments in some periods but not in others, we get this behavior where it goes from 700 million to negative 100 million to 830 million, and then it keeps jumping around like that all throughout this. So we get some very volatile numbers here. And then the final issue is that it's very difficult to pick terminal multiples that are consistent, that imply reasonable terminal growth rates, and that also line up with the unlevered DCF output. So if you go down and take a look at this, you can see what I mean. We've picked a terminal PE multiple of 11x, which matches roughly a 0.9% terminal free cash flow growth rate here. And looking at the numbers, we'd say this is reasonable, even though this keeps jumping around a good amount. By the end, it's probably in the low single-digit percentage growth rate range. With the unlevered DCF, it's a lot easier to pick numbers here because the cash flow growth rate declines more consistently. And if you go up here, you can see the issues that we're saying the unlevered free cash flow will grow by a slightly greater percentage. The EBITDA multiple here is around 8x. So in each case, we've picked assumptions that seem reasonable, but the problem is that if you cross-check them and cross-reference them, we just get implied equity values here that are somewhat different, even though within each analysis, these terminal value assumptions seem plausible. The bottom line about the levered DCF is as follows. It takes more time and effort because you need the cash and debt balances, you need the net interest, you'd have to calculate changes in debt. The second problem is that you get more volatile free cash flow numbers because of large debt issuances and repayments that distort the results. The third problem is that it's very difficult to pick assumptions that actually produce equivalent results to those of an unlevered DCF. And then the fourth problem, which I didn't even mention, is that there's also some disagreement about how to calculate levered free cash flow. Do you include all debt repayments, just mandatory ones? Do you include new debt issuances? There are all these questions and subtleties that you don't have to think about in an unlevered DCF. This question comes up of whether or not a levered DCF is ever useful. And the truth is you will see it sometimes for equity REITs because it's sometimes easier to predict debt and equity issuances there. Sometimes you will see it in restructuring and bankruptcy scenarios or other cases where the company's capital structure changes significantly. It can also be a useful screening tool in some cases to find LBO or acquisition candidates, but I don't really think it's better than normal free cash flow. The bottom line is that in 99% of cases, you shouldn't spend more than a few seconds thinking about this concept because it's just not a good idea in most real-world situations. To show you a few quick examples from banks, I have this one presentation from this renewable energy company in India, and they actually do project down to their levered free cash flow and use it in a management presentation. In another example, this presentation from Goldman Sachs for an equity REIT, they value the company in a DCF using levered free cash flow. And then in this final example from Evercore, they're valuing this oil and gas company. And once again, they project down to levered free cash flow and then what they call levered free cash flow after debt amortization. So you can see how even within these presentations, the banks don't always agree on how to calculate levered free cash flow. I'll link to all these presentations in the description or on the separate URL, so don't worry about it. I'll link to these and point you to the exact page numbers so you can see where these come up. We're at the end, so let's do a recap and summary. In a levered DCF analysis, you project cash flow to equity investors by subtracting the net interest expense and factoring in net borrowings. You saw it in our Excel file. We subtract the net interest expense and we factor in the debt issuances and debt principal repayments. If the company is preferred stock, if the company has unfunded pensions, if the company has NOLs, then you also have to include those in your levered free cash flow projections. For the discount rate, you use cost of equity rather than WACC. And then for terminal value, you want to use PE or some other equity value-based multiple rather than EBITDA multiple. And there's no bridge because you calculate the implied equity value directly as you saw down here in our analysis. There are many problems with a levered DCF. it takes more time and effort. You get volatile numbers. It's difficult and time consuming to forecast changes in debt. In our analysis, we did it here based on an assumed schedule for debt maturities for the company and a desire to stay within a reasonable debt to total capital percentage range. But in real life, it's often very difficult to forecast this accurately. And the bottom line is that a levered DCF offers no real advantages over an unlevered free cash flow based DCF. It's useful in some very, very specialized and rare situations in real life, but in 99% of cases when you're valuing real companies, you are much better off using the standard unlevered discounted cash flow analysis. That's it for this lesson. Hopefully now you know more about the levered free cash flow metric, the levered DCF, and why we recommend against using them in most cases.